Welcome to today's video, and we're going to highlight the concept of liquidity. So there are numerous definitions of the concept of liquidity in Forex trading. However, in this video, I'm going to use the simplest explanation possible. In simple terms, liquidity is a point in the market where it is believed money lies. Okay, this is what I mean. There are levels in the market where traders look to place their stops once they enter a trade, and it's a point where they believe if that point is violated, their entry on that specific trade is wrong. So for instance, traders looking to sell, rather go short in a market, will place their stops above a certain level of resistance, the traditional resistance level. So you put your stop loss above a level, and you believe if the market goes above that level, then your entry is wrong for some reason. And for those looking to buy, they'll put their stops below a certain level. So if that level is violated, and if that violation is against their entry, rather their bias on that trade, they'll consider that trade to be a wrong entry. So liquidity is a crucial concept, and there's this saying that if you don't know where liquidity is, you are the liquidity. So in some cases you won't know where liquidity is, but in most cases it's good to have an edge where in most cases you can tell where loads and loads of money is lying on the market. Because what normally happens is the market, before it goes in a specific direction, you'll realize a certain level is violated and it still goes in that same direction. For instance, you'll hear someone say, "Oh, my stop was triggered and the market really went the direction I had anticipated, but it had stopped me out," or something of that sort. So knowing where liquidity is, at least you'll know and look out for manipulation first, and then you'll enter a trade knowing the level has already been violated, so you are entering at the right time. So in this case, looking at the chart example, the horizontal line 1.27898 is a level of liquidity on GBP/USD 1 hour at this time. So you realize at that level, the conventional way of trading, the traditional support and resistance, so that would have been considered a level of resistance, because the market made a few attempts to the market made a few attempts, like twice. The first attempt was on 23rd August 2100, around 2000, the 1.27922 high. So it touched that level, and then it touched that level the second time on 23rd August 2100, the high of 1.27894. So you realize after those two instances, one would say that's a possible level of resistance, and they look to sell. But you see what happens after. The next time the market comes around that level, the 1.27898, it violates that level and pushes higher a number of pips above, more than 20, close to 30, over 30 pips above that level. And what happens next? The market sells. It's a clean sell. So you realize someone with a sell bias was right. The 10th August candle 1500 violated that level to manipulate, so it grabbed liquidity. So it triggered the stops that were placed at that point, So those people looking to the early sellers, for instance, they were stopped out. Those looking to those with stop orders, buy stop orders, probably interpreting this approach as let's say if the market breaks above that level, I consider that a breakout, so they put their buy stops above that level. So you realize those buy stops were triggered, but once it starts selling, buy stop becomes a loss, and those with sell stop orders, those with stop losses around that area, they were stopped out. So that's the essence of understanding the concept of liquidity. It's literally just knowing where money is lying on the market. So this is the buy side liquidity. So let's look at liquidity on the lower side rather on the support area, which is the sell side liquidity. So the 1.2942 area on the chart can be considered is considered sell side liquidity, an area of liquidity on the chart. So at this point, we have people looking to go long, rather to buy. At this point, they had their stop losses, their stop orders around that area. So those looking, interpreting any break below 1.2942 as a breakout, they had their sell stops around that area, and those looking to buy, they had their stop losses below or around that area. So the thing is, once the market touched that level a number of times, let's say the 11 a.m. 19th October and the 8 a.m. 20th October, it would be considered a support area. Yes, so what happens next? You realize third time the market comes around that area. So the next time, the third time the market comes around the 1.2942, it violates the area, grabs liquidity below it, and you see now the market pushes higher. It pushes higher. So it can be, liquidity can be both buy side, it's buy side and sell side. So you can use the horizontal lines, and in some instances the trend line. So we also have trend line liquidity, but it's still the same. So the buy side and sell side liquidity. So for trend lines, in this case, this is a trend line liquidity. So which kind of liquidity? We only have buy side and sell side. So this one is on the lower side, which is the support kind of liquidity. So there is money, a pool of money. People will look to place their stops around or below that trend line. So that becomes a trend line liquidity, but it is a sell side liquidity on a trend line. So for a trend line above that, let's say we draw a trend line above that. So this also becomes trend line liquidity, but it becomes trend line liquidity, but the buy side kind of liquidity, the trend line liquidity, the buy side trend line liquidity, because it's above. So we have stops at or near or above the trend line. So people looking to sell based on that trend line, they'll put their stop losses above or around that trend line. And those looking for a breakout, they'll put their stop losses also around or above that. So those trading breakouts, if that level is manipulated and the market sells, you realize they'll make a loss. And those early sellers, those who look to sell early and put their stop losses above that area before the manipulation, they'll also make a loss. So that's the essence of understanding the concept of liquidity. It's technically levels on a chart where people will place their money, so where pools of money are. So, and what normally happens after a level of liquidity is violated, rather what happens after grabbing liquidity, you normally see a displacement, and displacement is that huge movement. In this case, you see these huge candles, that is a displacement. So these two candles, they are huge candles, they're relatively bigger candles. The market creates what we call fair value gaps, rather an imbalance. So that's a concept we're going to look at in the next video. So if you found this video helpful, leave a like, comment, or share, and remember to subscribe. See you in the next video, where we'll be talking about fair value gaps or imbalance. See you.